What's up, Audit fans? Dr. Amanda White here with our October Q&A. We had a lot of questions come in on Instagram, on Facebook, and on YouTube. So in just a moment, we're going to dive right in. But first, I'm going to get myself a cup of tea. All right, got my cup of tea. And I'm not really a coffee drinker. Imagine me on coffee, it'd be a little bit insane. All right, this question says, hi Amanda, can you please break down the difference between SOX control testing, internal control testing, and ITGC testing? So, and sometimes you'll see me on camera and other times I'll switch down here to what you see on my tablet. So SOX actually stands for the Sarbanes-Oxley Act, which is something that we have only in the United States. Now, some companies may be doing SOX reporting if you are a dual listed company, so for example, a UK and a US listed company. But SOX control testing is testing of internal controls because SOX requires auditors to disclose any material weaknesses or control weaknesses that could be significant in affecting how the company runs and achieves its objectives. So really we're trying to identify control risks. Now, internal control testing is testing the company's internal controls, which with SOX and internal control testing, I would say that they're pretty close to being exactly the same thing. When you're trying to identify significant weaknesses in internal controls for Sarbanes-Oxley, you're also doing the same thing if you're testing internal controls as part of a general audit, because what you're trying to do is you're trying to find those holes or gaps or weaknesses that might lead to misstatements so that you can pinpoint down and do extra detailed substantive testing for them. Now, so SOX and internal control testing are the same. ITGC would be internal IT general controls. So when we have controls, I don't make a distinction between computer controls and human controls, but computer controls could be things like backing up of systems, secure access to systems, who has access to databases, to master price lists. So ITGC is testing the computer parts of general controls. So not controls set to specific applications or programs, but controls generally about IT at that company. So that would be things like, do they have a disaster recovery plan? Do they have a business continuity plan? What are their backups? How often do people change passwords? Who can access a computer? What happens to someone's access and ID when they decide to leave the company? Do we remove those? So those general controls are about the general environment. Then you will look at systems controls, so controls over specific applications and programs in terms of access, security, who can do what, again, those backups. And then those will both be part of the entire internal control system. So, when you think about the information and communication sections, ITGCs and IT application controls tend to fall more under those information systems and applications, but might also be specific control activities. So, Manju, I hope that answers your question. So Hiral Sony says, I'm very unclear about what exactly audit assertions are. The very definition of assertions is not very understandable to me. However, I understand the different types of assertions. So this is a really great question, and an assertion is not a word that you would probably use in everyday life. But the definition of an assertion is a statement that you think is true. Okay, so Kanye, when he busted onto the MTV Music Awards, and I think it was Taylor Swift was about to receive an award, and he said, hey, You know, I think that Beyonce's video was the greatest video of the year. That was Kanye making an assertion. So an assertion is anything that you think is true. Now, there are different types of assertions. So management at the firm, when they give you their financial statements, they are saying, here are the income statement, balance sheet, cash flow, and notes to the accounts that we think are true. So they're making an assertion about that number. What we then do is we apply our financial statement audit assertions, existence, completeness, rights and obligations, valuation allocation, understandability, classification, occurrence, cutoff, classification, accuracy. We apply those assertions to determine whether management statements about their numbers are actually true. So the audit assertions are essentially like characteristics of truth. So if you try to figure out whether one number is true, we're going to apply those specific assertions. And if those specific assertions all tick off, then you're going to say that that's true. So the assertions are really characteristics of truth. So Haral, I hope that answers your question. Vikramaditya? I hope I said that correctly. Vikramaditya? Oh, Vikramaditya. Vikramaditya. I don't know. I'm terrible with names, but I'm sorry if I've butchered your name. But this person asked about what is benchmarking. And that's kind of an unusual word because we don't actually have any auditing standards on benchmarking. But the way that I would consider, oh, I'm about to sneeze. Oh, I swear I was going to sneeze again because usually I sneeze in twos. Maybe I'll have a sip of tea and see if that makes a difference. No, second sneeze is gone. Okay, so when I think of the word benchmarking, I think of the word comparison. And the most often, or the most common time that I would do a comparison on an audit is when I'm doing analytical procedures under ASA 520 at the very beginning of the audit, where I want to compare my client to other firms within the same industry. And I might use specific companies, or I might use a collection of companies in an industry average. Now, from a consulting perspective, benchmarking is often, and I was often called in to do benchmarking exercises when I was at Coopers and Lybrand and then PwC, where we would benchmark company performance, company processes against other companies in similar industries to find out whether they're doing better or worse. So one of the things we might do when we're auditing a client, when we're evaluating their internal controls, we're identifying risks, is that we will be making comparisons to other firms within the same industry, and we might recommend to those clients best practice. But the most common time that I would use benchmarking as a comparison is in the analytical procedures. So I hope that answers that question. So we have Abhinav Atwell, who said, "Hi Amanda, I'm very thankful for your videos. I just regret that I didn't know about you earlier. I'm sorry about that. I have my CA Intermediate, which is the Indian equivalent to CPA, exam in 14 days. It would be nice if you could give me some tips on last day revisions." All right, so my tips for studying auditing is that auditing is this holistic study of a whole range of different moving parts. You need to know about accounting, you need to know about auditing, you need to know about financial accounting and management accounting, and it all fits together. So I'm going to put together a little playlist of videos, and I'll put them in the description to this one that might help you. The first thing I would start with is concept mapping. So I've got probably one really great video on concept mapping that I'll include. It really gives you a good idea of, well, what the heck is going on in audit and how the concepts are linked together. So I'd start with concept mapping. Then I would look at what the learning objectives are in the module or the exam or the assessment are that you're trying to do. Now, because this is the CPA sort of professional qualification, you could look at ACCA. So ACCA, which is the UK-based organisation, they have past exam papers available on their webpage. So I go to the ACCA page and perhaps look at past exams. But the key for my students, and I've also got some general study tips that I'll link through about how to handle reading time and preparation for open book exams, which is quite often the case for our accounting professional qualifications, is that you need to know if you're doing revision over work that you've done in workshops or modules. Why do I need to know this? What is important? So it's not just, can you figure out that A is the answer, or we have to give an unqualified opinion? You need to know why that is, and then how to back that up with paragraph references from the specific standard. So that is probably my best tip. So the concept mapping, to make sure that you understand what's going on, and you can look at my concept maps to see what you might be missing. I'm going over all of your learning materials. Now I also have full lectures, so you might want to use those. I also have a whole lot of videos, and I'm about halfway through our Standards Explained series. So there's a whole lot of videos on different standards, and then looking at if you can get past papers for your particular exam, having a look at those, look at the style of questions, because most often they give you some marks for being correct, but they quite often give you more marks for having the right explanation and justification and standard references besides being correct. So good luck, Abhinav, for your exam. I hope you do really well, and let me know how you go. There was a message from Abdullahi Usama, but they speak English and French. God, imagine learning audit in English and French. They just wanted to say a thank you. So thank you for watching, and if there's anything I can ever help you with a question, just let me know. Let's see what else we have. Oh, this is a good one. So from M. Amir, and M has a few different questions. So I'll start with the first one. How do we correlate accounting standards with auditing standards? That's a really good question. I'm going to switch to my tablet here in the view. When it comes to accounting standards and auditing standards, it might be easier if I draw this out. Okay. So what the accounting standards do is they guide us in terms of what goes into, oh, that's not the pen I wanted, what goes into our profit and loss, and what goes into our balance sheet, and what goes into our notes. All right. So the accounting standards help us understand exactly how to do those calculations, and also how to do the disclosures. Now I know I'd usually normally use a stylus, but somehow in the last 2 weeks I've lost all of my styluses. So I'm just using my finger. Now the auditing standards themselves are processes really on how to do the audit. All right, so they're, calculating, gathering evidence, making conclusions, and the auditing standards really apply to the entire set of financials. So there's not really a correlation between an auditing standard on X meets an accounting standard Y. They don't quite match up like that. Now, sometimes there are some standards where there is specific correlation. So for example, the IFRS on subsequent events, which I think is IFRS 101, will match up very specifically with ASA, ISA 560. There's a standard, there's an accounting standard on going concern, there's an audit standard on going concern. There is an accounting standard on liabilities, including contingent liabilities, and there are standards on estimates for revenue, for assets, for expenses, and those are all covered in ISA 540, which is the accounting standard, the auditing standard on audit estimates. So they don't quite match up as clearly as that. All right, so let's look at M's other questions. There's only just one more. What exactly are substantive procedures? Now, I'm going to flick back down here to my tablet. So I know that on the audit, I'm going to generate an audit report. And to be able to generate that report, the auditing standard says that I need to come to conclusions based on audit evidence. All right, so I can't just make a guess at what the audit report should be. I should do my audit report based on gathering evidence about the company. So there are different ways that we can conduct or collect evidence, and we will normally do, let me adjust my screen here. two types. The first type that we're going to do is that we're normally going to test internal controls. Now, that might not be the case in small companies, but in most large organizations, publicly listed firms, you test internal controls. That'll give you some evidence then to help guide the level of substantive testing that you're going to do. And so you're going to use both of those forms of evidence to make conclusions. So substantive testing is really just using audit procedures to gather evidence about the assertions for every single account and every single disclosure in the financial report. So you could be looking at documents. I've got a whole huge playlist of videos on substantive testing, and I'll be sure to put them in the description to this video for you. All right, now let's move to questions that I had on Facebook. All right, so Snaya Bazniat asked on Facebook, how can you be sure what assertion is applicable to a particular case? I feel like they can all be debated and applied. And what they mean there is that, you might be given a scenario and it says, okay, what is the key assertion that's at risk or is being addressed here? Now, if you're ever given a situation and said, okay, well, what assertion is this? Usually you're given some sort of description about a risk. So something like, in accounts receivable, there is a possibility that people may not pay their accounts as they fall due. They may choose not to pay, or they might go out of business. So if we're thinking about what assertion applies there, that would be the valuation and allocation assertion, because the little description is talking about collectability of money. Can we recognize all of that amount? Now, if I was doing sales, for example, and I said, we have sales made by salespeople. Those salespeople earn a bonus based on the number of sales they make in a month. Well, then the risk there is going to be around the occurrence assertion. So there's no easy way to have a rule about how to figure out what assertion matches a particular scenario, but you might have to say, well, what is at risk? Are we at risk of overstatement or understatement? Are we at risk of transactions being real or not real? So the question here really comes down to, do you know your assertions? And if you know your assertions, then perhaps just try walking through them one by one. Could this be an existence issue? No, that they're talking about that it's okay, everything, they think everything's going to be real, but they're more worried about calculating the value. Well, then that's going to be the valuation and allocation assertion. So I think they're getting down to understanding assertions is really going to help you. Now, in an exam situation, you might be asked to explain, so then you could justify. But there are some things that you couldn't really justify at all. So if I was talking about that accounts receivable one, then I wouldn't say rights and obligations, because rights is, do I have a right to recognize that accounts receivable? And there was nothing in the little blurb about that specific area. So that would be that. And there's a little follow-up question. For example, identify an assertion that might be linked to a test of internal control. Control tests test internal controls. Controls, yes, try to make sure that every account is, all transactions are recorded according to the assertions. They really did happen, recorded at the correct amount. We've included everything. So that means then you need to understand, well, how does that assertion relate to a control? So think about the occurrence assertion. With the occurrence assertion, I want to make sure that all transactions are real. So what is there in the system of internal controls that could prove that all transactions are real? Barcode scanning, unique identifiers of each inventory number that was sold. You can only record a sale if you scan the barcode, for example. Then if you think about accuracy, well, that might be automatic prices or calculations or totals or discounts within your system. Completeness might be something like the scales at self-serve scales for supermarkets. So it calculates what you've scanned versus what's weighed in the bag to figure out whether everything has been recorded. Cutoff might be, if you make a transaction around the end of the year, what's the accounting process around that? And then classification comes down to really programming of your system for automatic journal entries. So there's no easy way. And the example here is price changes are pre-approved. However, and the answer there is accuracy, because we're talking about price. And Snaya said, well, I think completeness could be an assertion here, but completeness is, are there any transactions that are missing? All right, so how does an incorrect price relate to missing transactions? And that's not really going to be the right match. So if you can understand what the purpose of the control is, then it should be easier to link it through to the assertion. So I hope that answers your question there. All right, so now I'm going to move to Instagram. Oh, here we go. So a question from Jimmy, the difference between unqualified and unmodified audit opinions. So let's go into my tablet here and look at different types of audit opinions. All right, so we have to give an opinion of some sort, and ASA700 is the area where we talk about unqualified, unmodified opinions. Now, there actually is no difference. If you said unqualified, I would take that to mean the same thing as an unmodified opinion, because unmodified opinions, let's look at the opposite. Modified opinions are opinions that we see in ASA 705. All right, and there's a couple of different types depending on the severity of the instance that you're looking at. So remember, there are two types. You could have a disagreement with management, and that's about a number or a disclosure, or you could have a limitation of scope, and that's an inability to get sufficient appropriate audit evidence. So if you have a disagreement with management and it's material but not pervasive, you're going to have what we call a qualified opinion. If you've got a limitation of scope that's material and not pervasive, again, that's going to be the same, qualified. If you have material and pervasive disagreements with management, so multiple, and I always think of the octopus, think about an octopus sitting on the financial statements, many, many misstatements, or think about the blue whale, which is the world's largest whale, so large, but it's only one thing, then you'd go with adverse. Or if you've got a limitation of scope that's so large, you can't collect a lot of evidence on a lot of areas, you're going to go with a disclaimer of opinion. Now you might think, why is there the word unmodified? Because that's really confusing. And that comes from the days when we had modified opinions and unmodified opinions. We still have modified and unmodified opinions, but modified opinions used to include emphasis of matter, and that became really confusing. So before emphasis of matter and other matter went into their own standard, then that was a bit confusing, because you could have an unqualified with an emphasis of matter, which was technically unqualified but modified, but we don't have that anymore. So if you said unqualified or you said unmodified, I would presume you mean the same thing. You're always best to use both terms, so use unqualified, unmodified, but remember, to the unqualified, unmodified, you can add an emphasis of matter paragraph to that. If you've got a going concern, material uncertainty, or a significant subsequent event that you think needs to be disclosed. Our last question for today does come from Stacey, and she's an SMSF auditor, and she just had some questions about emphasis of matter and other matter paragraphs. So if we switch over into our tablet here, we'll see that ISA 706 is the one that covers emphasis of matter and other matters. And there's some distinctions that you need to know. So with emphasis of matter paragraphs, it has to be about something that management already have discussed in the financial statements. So there are two reasons generally why we have emphasis of matter: a material uncertainty for going concern, or because there's a subsequent event that we think needs to be disclosed. The third thing that's less common is that you think that there's something really important in the financial statements that has been disclosed by management that you're just highlighting and saying, look here at this particular information. So that's an emphasis of matter. The other matter paragraph is when we want to draw attention to something that isn't mentioned by management. So that could be something in the front half of the annual report. So remember, there's lots of pages to the annual report before we get to the financial statements. So is there something in those areas that we think needs discussion? Now, there is a lot of risk, obviously, in SMSF audits. They're very difficult to do because of the low cost nature. So there's very low margin in them. There's a lot of pressure on SMSF auditors to do their audits quickly. You might be thinking, what on earth is an SMSF? An SMSF is a self-managed super fund. So that's a self-managed retirement account. So rather than putting your retirement savings with a big company, the SMSF means you control all of that. Now, there's a lot of government rules and regulations. So SMSF auditors not only need to follow the auditing standards, but also very specific government legislation on SMSF rules and regulations. But if you have something risky, and the example that Stacey gives is a fund that has an investment in a high-risk unlisted unit trust or a loan to an unrelated entity, I would assume that those would need to be disclosed in the financial statements somewhere. As long as they're disclosed, then what I would do is, if you think they're a high risk and they pose a risk to the viability of the fund, or they expose them to significant risk of loss, then I would include something in the emphasis of matter paragraph. I wouldn't put it in the other matter paragraph if management have already discussed it. Now, if it's something that the accounting standard says, yes, it should be in the standard, and management are refusing, then you've got a disagreement with management. And when you've got a disagreement with management, you want to go for what we call a qualified or an adverse opinion, depending on the severity and the pervasiveness of that particular item. Well, that was a pretty huge Q&A video for October. Now, of course, remember that I'm doing my Standards Explained project. I'm trying to have all of those standards done by Friday the 9th of November, because that's the day my auditing students have their final exam. So I think I have 15 standards to make videos on in 20 days. So it's almost a video, just hopefully if I can make a video a day, we will hit our target. So I'd love it if you'd subscribe to the channel to get those updates. If you have any other questions, pop them in the comments, and I will see you next time. Bye.